If you've spent any time at all in the world of DeFi, you've seen them, those promises of absolutely sky-high returns. But it makes you wonder, right? Is that yield built on something solid, or is it just a temporary sugar rush that's destined to crash? Well, let's dig in and find out.
And that right there is the central question we're going to unpack. Because understanding the difference between a real, sustainable return and one that's just being powered by inflation, well, that's absolutely crucial for anyone trying to navigate the DeFi space.
So, to really get why real yield became such a big deal, we have to go back in time a little bit. We need to look at what came before it, this explosive, incredibly attractive phenomenon called yield farming.
At its core, the idea of yield farming is actually pretty simple. You take your crypto assets, you lock them up in a DeFi protocol to provide liquidity for things like lending or trading, and in return, the protocol rewards you. It's all about putting your idle assets to work to generate some passive income.
And when I say rewards, I mean the rewards were staggering. Forget 5 or 10%. No way. Some protocols were offering annual percentage yields or APYs of over 400%. This promise of just massive returns attracted a flood of capital into DeFi and really kicked off the legendary DeFi summer. But you know how the saying goes, if something seems too good to be true, it probably is. The engine behind these unbelievable yields had a really serious, unsustainable flaw. And that engine was something called token emissions. Essentially, what was happening was that protocols were just printing their own native tokens out of thin air and then handing them out as rewards. So it created the illusion of a high yield, but really, it was just a form of inflation. This is where it all goes wrong. This practice led to a really toxic cycle. So a protocol would launch with this massive APY from emissions, attracting what's known as mercenary capital. These are just users who are only there for the rewards. As soon as they earned these new tokens, they would immediately dump them on the market for stablecoins or ETH. All of that constant selling pressure would just crash the token's price, which made the high APY worthless and caused all that liquidity to flee to the next high-yield farm. And this wasn't just a theory. It was a huge, well-documented problem. As DWF Labs pointed out, this whole thing created a race to the bottom, and it left a trail of decimated protocols and token charts in its wake.
But out of the ashes of all these unsustainable models, a new narrative started to emerge, a focus on something far more durable, a focus on real yield.
I think this analogy makes the difference crystal clear. Think of fake yield like a company that pays dividends just by printing more of its own stock. Yeah, you're getting more shares, but you're also getting diluted. Real yield, on the other hand, is like a healthy, profitable company that shares its actual earnings with its shareholders. One is a gimmick, the other is the sign of a real business.
So the crucial difference is the source. Fake yield comes from inflation. Real yield comes from actual protocol revenue, like fees from swaps or leverage trading. And just as important is what you get paid in. Instead of getting paid in some volatile inflationary native token, real yield protocols pay their users in established assets, like ETH or stablecoins like DAI. Okay, so this all sounds great in theory, but what does it actually look like in practice? Let's take a look at a few of the pioneering protocols that are making real yield a reality.
We're going to look at 3 key examples here: GMX, Gains Network, and Synthetix. And what's interesting is that each one has a different approach to generating and distributing this real revenue-based yield.
First up is GMX, a decentralized perpetual exchange that really became one of the poster children for this whole real yield narrative.
The GMX model is pretty straightforward. GMX earns fees from traders, and then it distributes 100% of those fees back to its stakeholders. 70% goes to liquidity providers, and 30% goes to those who stake the GMX token. And the key part? All of these rewards are paid out in real assets like ETH or AVAX. Now, the risk for the liquidity providers is that they are the direct counterparty to traders. They are the house, which means they profit when traders lose, but they also have to cover the bill when traders win. Okay, next we have Gains Network, another perpetuals exchange that takes a slightly different and very innovative approach to how it handles liquidity. Gains Network's big innovation is its single DAI vault. So liquidity providers just deposit the stablecoin DAI, which completely eliminates the risk of impermanent loss. But there's a different risk here. If traders are too profitable and start to drain that vault, the protocol mints its native GNS token to cover the losses. This means GNS stakers are the ones who can get diluted. And it creates a potential death spiral if traders just keep on winning. And finally, let's look at Synthetix. This is a DeFi original that has evolved into a foundational layer for derivatives, and it has fully embraced the real yield model. Synthetix made this huge pivotal shift. They ended their token inflation to tie the token's value directly to the revenue the protocol generates. And their strategy is really interesting. They act as an infrastructure layer. Instead of being a single exchange, they provide liquidity as a service for other protocols to build on top of. This allows Synthetix to earn fees from a whole ecosystem of applications, making its yield much more diverse and robust.
So, after seeing these examples in action, what does all of this mean for the future of DeFi?
Why this all matters is pretty simple. It's a sign of maturity. The move away from these inflationary gimmicks and towards real revenue-generating business models shows that DeFi is growing up. It's about building protocols that can survive and thrive in any market condition, not just in a bull run that's fueled by hype.
And this leaves us with a final and pretty crucial question. What does this shift towards real, sustainable value in the crypto world actually mean for the entire future of finance?